Hi, everybody. Thanks for joining me today. Today, I'm going to be using Value Line's digital platform and investor tools. And I'm going to show you how to quickly and easily find worthwhile investment candidates. Going further, I'm going to recommend one stock to buy right now. Just give me one sec, do some housekeeping. As mentioned, if you have questions, please type them into the Q&A section, and I will get to them at the end. To start, I thought it best to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including the 1,700 that are included in this service. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. Before I begin the formal presentation, I thought it worthwhile to include an overview of the economic situation, as well as Value Line Research Department's view of the stock market. The following content was prepared by Harvey Katz, Value Line's chief economist. The first half of this year is shaping up as a tale of two divergent quarters, with the opening period's undistinguished performance likely being followed by a decidedly better showing in the current 3 months. True, the first quarter's pedestrian 1.2% increase in gross domestic product was partly a seasonal phenomenon. However, there also were lesser rates of consumer and defense spending and a notable drawdown in inventory. By comparison, the second quarter is likely to see a seasonal catch-up in consumer spending, gains in defense and business outlays, and a solid rebuilding of inventories. That combination should lift GDP growth into the 3% range. More consistency is likely in the second half, with fewer seasonal adjustments, but continuing gains in consumer spending and capital goods demand, and further resilience in home building expected to be key themes in this mature economic expansion. That persisting strength should enable growth to average about 2.5% in the third and fourth quarters, lifting the projected rise in GDP for the full 12 months in the 2% to 2.5% range, up from 1.6% in 2016. Meanwhile, politics in Washington may play an increasing role, with efforts to revise healthcare, bring about tax reform, further loosen regulations, and generate needed improvements in the nation's infrastructure, all on the negotiating table, and some likely to face notable opposition. Success in these politically charged categories probably will be needed if our forecast of a further step up in growth in 2018 is to be realized. Recent events underscore the dangers the world is now enduring. Not only do we face lingering conflicts in the fractious Middle East, with Russia and with North Korea, but as recent attacks around the world have affirmed, the global terror threat has not diminished. Meanwhile, the bulls continue to show their determination, coming back quickly from a brief but sharp mid-May sell-off. Solid earnings support, largely improving economic fundamentals, and the likelihood that a cautious Federal Reserve will just gingerly tap on the monetary brakes this year continue to help offset the political headwinds domestically and the perpetual crises abroad. In conclusion, such ongoing support is pivotal, as P/E ratios remain at levels that leave little margin for error. Now for the core presentation. As you can see, I am now at our homepage, valueline.com. On this page, you can access, free of charge, daily market commentaries, as well as general interest articles that are written by our analysts. I'm now going to sign in with my username and password. After entering my credentials, I am taken to the welcome screen. From here, I can quickly get to many important areas of our website, including Browse Research, which is the main home for our core equities products. I can also head over to our investor tools, as well as homepages for our monthly stock selection services. Since the goal for today is to find a worthwhile investment candidate, I'm going to start with the screener. Individual subscribers are entitled to a number of Value Line preset screens, as well as 50 data fields. Please note, however, that almost 200 more fields are available, but require a higher level of subscription. As Harvey Katz mentioned above in his stock market commentary, PE ratios remain at levels that leave little margin for error. In fact, the median of estimated price-to-earnings ratios for the 1,700 stocks under Value Line review is a robust 19.5. For comparison, this figure was 18.3 1 year ago and just 10.3 on March 9, 2009, which was the low point of the market during the Great Recession. Clearly, we have come a long way in a relatively short period of time. Please note that these PE figures are updated every week for subscribers. I always recommend that subscribers regularly review this data. It provides a great snapshot in regard to how the universe of stocks under Value Line review are being valued by the market. For this exercise, I'm going to use Harvey Katz's PE opinion, along with other important variables, to find a worthwhile stock to buy right now. This stock will, compared to the broader market, be less expensive, relatively safe, and possess favorable growth prospects so that it would meaningfully participate in the bull rally should it continue. Simply put, my plan is to find a conservative issue with upside. Naturally, let's start with current PE. Value Line's calculation includes a combination of actual and estimated earnings per share, which we feel is a more accurate method of evaluating a specific stock when compared to just using earnings from the past 12 months, for instance. Since the median PE of the whole universe is 19.5, I want to display stocks with considerably lower PEs. Let's go with 18 at the high end. I'm also going to make 5 the low end, since I want to avoid extremely low PEs. To accomplish this, I can simply tighten the horizontal band, or even easier, just type in the from and to values. Okay, we just went from more than 4,000 results down to under 1,000. As mentioned, I want the stock to be fairly conservative. The Value Line proprietary safety rank is perfect to weed out risky candidates. The safety ranks measure the total risk of a stock and is arranged on a 1 to 5 scale, with 1 being the most stable issue. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. For this, let's focus on stocks that have risk profiles that are better than average. So I click on the 1 and the 2. As you can see, 118 stocks now meet that criteria. Next, many conservative investors prefer to invest in companies that pay dividends. At present, the average yield for dividend-paying stocks in our universe is 2.1%. This figure is updated each week for subscribers. So let's add that field and set the minimum at 2.1%. All right, we're now down to 77 options. We're getting closer, but it's still far too many. To make sure that we are focusing on companies that are growing, I'm going to utilize Value Line's proprietary estimates and projections. All of these figures are created in-house by our research team. So from the screener list, I'm going to select projected 3 to 5 year EPS growth. This is the expected average annual growth of share earnings calculated by our analysts. I'm going to set the minimum bound to 10, which is a healthy rate. Overall, companies that are expected to achieve this rate or close to it, should be firmly in growth mode. Okay, 6 results, which is a manageable list. Any of these stocks may well fit nicely in an equity portfolio that wants to balance risk and reward. If you're like me, you tend to watch a batch of stocks for a few days or weeks before seriously considering taking a position. Value Line's Watchlist tool makes this easy. I can access Watchlists from the menu above. To save time, I have already created the watchlist for these stocks, but the process is very quick and easy. Simply click on Create Watchlist and follow the steps. Using the Alerts hub, which can also be accessed here, users can set up notifications and receive an email or text message when a notable event occurs for a specific stock. You can set up alerts for a variety of events, including when the price of a stock moves considerably, when Value Line changes the rank of a particular stock, or when a new Value Line report is available. In total, more than 15 alert functions are present. Let's now go back to the list. A quick scan of the stock shows that only Cardinal Health is top ranked for safety. Cardinal also possesses a number of other investment attributes, and I'm going to take you through a few of those. Let's click on the company name and get more information about this issue. I am now on CAH's digital stock report, where the data, information, and analysis is arranged in more than 15 modules or boxes. These modules can be moved around, resized, and hidden so you can create your own customized stock report. For instance, let's say I'm most interested in the analyst commentary. I can simply grab the box and move it to the top. In addition, now I want to see more ranks-related information. For that, I simply click on the larger rectangle in the heading. Once I alter the presentation, I can save the changes from the sliding horizontal action bar. The next time I come to this report, it will look the way I set it up. Let's now get some background information in regard to Cardinal's business and prospects. As some of you may know, the company has struggled of late. In the most recent analyst commentary, senior analyst James Flood stated, "Conditions in the pharmaceutical market remain difficult. As a leading distributor of prescription drugs, Cardinal has long generated solid and well-defined earnings by taking a small fraction every time its drug prices were increased. With the recent public awareness of rising drug costs, now a political issue, pharmaceutical companies are facing a backlash from insurers. Indeed, in the March quarter, the price of generic drugs declined, resulting in the company posting a rare 7% drop in operating profit year over year in this segment. Considering the lackluster environment, now let's take a look at the recent performance of Cardinal stock. From the valuation module, I can quickly pull up the stock chart. The yellow line displays the monthly highs and lows of the stock, and as you can see, it has declined of late. More specifically, over the past year, the price has dropped about 7%. For comparison, the S&P 500 index is up more than 15%. We think that this notable underperformance has created a good entry point for investors. As you can see in the graph, the current stock price is trading well below our 3 to 5 year target price range. Those are the horizontal bars right here. This range is an extremely popular Value Line proprietary metric, and most other research houses do not provide such projections. Cardinal is trading around $74 a share, and our range to the 2020-2022 timeframe is 110 to 135, suggesting significant appreciation potential to that period. I now want to show you our classic PDF report, which is included with a digital subscription. And let's look at some analysis on why we think the stock will trade at that lofty level. Going back to James Flood's commentary, and more specifically his investment advice in the last paragraph, these shares may appeal to certain investors. Assuming the company is only in a short-term cyclical downturn, CAH holds attractive long-term appreciation potential. In addition, our positive outlook includes Cardinal completing a major acquisition, It is in the process of purchasing Medtronic's patient care, deep vein thrombosis, and nutritional insufficiency businesses for $6.1 billion in cash. These operations encompass 23 product categories that are used in most U.S. hospitals. For the year ended last October, the assets to be acquired had revenues of $2.3 billion, with 70% of the sales being derived domestically. This transaction is scheduled to be completed by September, and in our view, would provide Cardinal with another profitable business line and an expanded product roster. If this acquisition were to be completed on time and integration procedures go as planned, we would almost certainly increase our financial projections. Please note that it is Value Line policy not to include contributions from acquisitions until they are formally completed. All told, Cardinal Health, in our view, will make a fine addition to most conservative long-term investors. I hope you found the process for finding a stock to buy right now interesting, informative, and efficient. I also want to point out, however, that Value Line offers a variety of model portfolios that can help alleviate the work of finding worthwhile investment candidates altogether. As part of the Value Line Investment Survey is the weekly Selection and Opinion newsletter. Along with economic and stock market commentary, are 4 model portfolios. Each one has a different investment strategy, is actively managed, updated each week, and always contains 20 stocks. The portfolios are overseen by senior research analysts. Portfolio 1 is best suited for aggressive investors and focuses on stocks that are expected to outperform the broader market over the year ahead. Portfolio 2 should be of interest to more conservative investors and focuses on dividend-paying stocks that also offer worthwhile appreciation potential. Portfolio 3 chooses equities with long-term price growth potential and, of course, is best suited for patient investors. Portfolio 4 is filled with stocks that possess above-average dividend yields and is for investors seeking current income. We have a great number of subscribers that follow these portfolios. For those interested in possibly adopting one of these strategies, here are a few helpful details. New positions always amount to 5% of the market value of the respective portfolio at the time of the trade. Any dividends received are simply taken as cash. They are not reinvested. Lastly, the portfolios are not rebalanced. All told, the model portfolios represent some of Value Line Research Department's best investing ideas, and we recommend that you read the analyst-created content and look over the portfolios for possible additions to your holdings. Subscribers looking for a total investing solution are also encouraged to check out our monthly stock selection services. They are Value Line Select, Dividend Income and Growth, and Special Situations. If this is something that sounds up your alley, call 1-800-VALUE-LINE for a free sample report. This marks the end of the formal presentation, and I will now take your questions. All right, first one, does Value Line provide research on ETFs? Yes, we actually have 2 ETF products. There's the Value Line ETF Survey, which provides data and screening capabilities on more than 2,000 ETFs. It's every ETF that's listed in the US and Japan. In addition, we recently launched a new product, and that's Value Line Select ETFs. This product each month recommends an ETF for purchase. It provides ample data, analysis, and overall reasons for the recommendation. And that's created in-house by a senior analyst. All right, next question for the model portfolios. What's the annual turnover? It differs among the portfolios. For portfolio 1, the average annual turnover is typically around 200%, or looking at another way, the portfolio turns over completely on average every 6 months. Since that strategy is fairly aggressive and relatively short-term in nature, there's a lot of trades. Portfolios 2 through 4, or 2, 3, and 4, they have far less turnover, maybe 50% to 75% a year. So those interested in following one of those portfolios, trading costs need to be considered. Looks like we only have one more question. Let me just check first. This is about the digital report. Do you have to change the format boxes on each stock, or will it save all digital formats you pull up on all stocks? It's actually a really good question. Unfortunately, those changes have to be done per stock, per report. Reason being, we have all different formats for stocks. For instance, we looked at Cardinal Health. That format is, of course, going to be very, very different than to an electric utility or a real estate investment trust or an insurance company. So there's different modules for different stocks. So it does have to be done individually. All right, one more stocks. How are the stocks chosen for our coverage? As some of you probably know, we launch coverage on stocks almost every single week because other stocks go out to acquisition, delistment, the occasional bankruptcy. When we select new stocks, admittedly, it's probably more art than science, but we always look at market cap, trading volume, profitability, and business prospects. The goal is to launch coverage on a stock and hopefully hold on to it for a long period of time. We try not to add something that's going to go out of business 3 months later. We also do accept subscriber suggestions. So if you are interested in a stock and we don't cover it, please let us know. I can't, however, make any promises as far as when it's going to be added, but I do add it to the list. Let me just check one more time. That appears to be the last of the questions. Thank you very much for attending, and please let us know if you need anything else. Take care, everybody.